When you check your savings account or apply for a mortgage, it is easy to assume the numbers you see were decided by the bank down the street. But those rates actually come from a market most Americans never look at, a $145 trillion machine that quietly prices your car loan, your job security, and your retirement account. Right now, the national average savings account pays around 0.38%. It sits there, backed by the standard FDIC guarantee. Meanwhile, 3-month U.S. Treasury bills yield closer to 3.7%. Both options offer the exact same government-backed safety. The only difference is the institution holding the cash. Leaving $50,000 at a typical bank instead of moving it to treasuries costs you over $8,000 in missed interest over 5 years for no extra protection. That $8,000 gap is a silent tax on anyone who stays within the traditional banking system. Forfeiting that yield is the immediate, measurable consequence of ignoring the machinery behind the counter. A bond is simply a loan. Instead of going to a bank, a government or company borrows money from investors. You hand over a fixed amount, the principal. They promise a regular interest payment, the coupon, and they promise to return your principal on a specific maturity date. The United States government borrows more than anyone else on Earth, paying over $1 trillion a year in interest alone. That immense scale gives it the power to dictate the baseline cost of money globally. This entire system hinges on a mechanical, inverse relationship. When interest rates rise, the price of existing bonds falls. Suppose you buy a $1,000 bond paying 3%, yielding $30 a year. A few months later, the government issues new bonds at 5%. No one will buy your old bond for $1,000 when they can get a new one paying more. To sell it, you have to drop the asking price to about $600 to offer a competitive yield. You haven't lost any future coupon payments if you hold it to the end, but on paper, the value of that asset has collapsed. That simple mathematical trigger is exactly what causes the major financial disasters we see in the headlines. Of all the bonds trading out there, the 10-year U.S. Treasury yield is the universal benchmark. When a bank decides what mortgage rate to offer you, it looks directly at this number. The bank asks a basic question: why lend to a person for 30 years when they can lend to the government for 10 years risk-free? To make it worth their while, they take that 10-year Treasury yield and add a roughly 2-point risk premium to account for the chance that a regular person might default. This animated chart illustrates a direct comparison for a buyer named Brian. If the 10-year yield moves up by a single percentage point, Brian's mortgage rate climbs with it. Over a standard 30-year loan on a $400,000 house, that 1% hike adds $96,769 to his total cost. He buys the exact same house. The only thing that changed was a bond yield in a market he never visited, handing him a massive 6-figure bill without ever sending an invoice. For decades, financial advisors pushed the 60-40 portfolio as the conservative default. 60% in stocks for growth, 40% in reliable bonds to act as a safe seatbelt when those risky stocks unexpectedly crash. In 2022, the Federal Reserve raised interest rates faster than at any point in 40 years. Following our golden rule, those rising rates cratered bond prices at the exact same time the stock market was selling off. The hedge broke because the rising rates were poisoning both assets simultaneously. This graph shows how a metric called duration multiplies that pain. Duration estimates how much a bond fund will lose for every 1% rise in interest rates. An intermediate fund with a duration of 6 took a bruise, but long-dated funds with a duration of 17 suffered catastrophic historic losses. Millions of retirees assumed their bond funds were entirely safe. Holding one of these funds without checking its duration on the fact sheet is functionally equivalent to driving a car without knowing if the brake lines are cut. Beyond personal portfolios, this market also predicts the wider economy. Under normal conditions, locking your money up for 30 years demands higher compensation than a 3-month loan. Economists call this extra payment the term premium, resulting in a naturally upward-sloping yield curve. This chart plots U.S. Treasury yields across every maturity. Occasionally, it warps. Short-term yields bizarrely surpass long-term yields. When the curve inverts like this, the market expects the economy to slow down so severely that the Federal Reserve will be forced into emergency rate cuts. An inverted curve is a heavyweight economic signal. Over the last 70 years, this specific anomaly has perfectly preceded every single U.S. recession. It is a 10 for 10 record. Research from the Federal Reserve Bank of San Francisco indicates that this signal is the most accurate predictive engine of financial behavior in existence, often moving months before a slowdown appears in official data. This market dictates the value of every dollar in your financial life. It is the fundamental price of time and risk for the entire world. For your cash, this means checking your yields today. If your money is sitting in a neighborhood bank earning next to nothing, you can capture the baseline yield by moving it into T-bills, I-bonds, or a high-yield savings account. For your retirement accounts, pull up your bond fund's fact sheet. Locate the specific duration metric. Anything above a 7 means your portfolio is heavily exposed to interest rate movements, and you need to assess your true risk. And for major life choices, look up the 10-year treasury yield. Treat it like a check engine light before you lock in a new mortgage or auto loan. Every dollar in your financial life is touched by this system. The people who successfully grow their wealth aren't necessarily smarter than you. They simply stopped pretending this invisible machinery was boring.